a lot of places. There we go. Forgot to get the recording going there too. You can find me on Facebook, Twitter. Obviously, we got our website, wealthbuildershq.com, and a lot of other places as well. And personally, I stay pretty busy. That's my old jacket there. I still have that, actually. I don't know if it probably fits me. I gained a few pounds. I got to work on that. But anyway, you can see that I'm busy with the E-mini think tank. Several days a week, we trade live data in the markets. We trade in simulated mode for safety reasons and for educational purposes, but basically looking at the markets live, and there's a lot of education in there as well, especially some of the stuff I'm going to talk about today. You'll actually see a lot of that in the E-mini think tank. So we'll talk a little bit about what that is and how it works. You can see I'm wearing my shirt today, E-mini think tank. We also had the Wealth with Spreads programs. If you're interested in some little longer term type stuff, spread trading for the futures markets. Sorry, I'm laughing at my dogs. Duck just flew in my backyard and they decided to go play with it. Anyway, so like I said, I'm going to be kind of talking about some of the tools that I deal with in the E-mini think tank. Actually, let me see. Am I still logged in? There it is, members. And the neat thing, like I was saying about this program is that, when you go enroll in programs like the E-mini think tank, oops, I'm not logged in right now, as a matter of fact. So I'll log out and then back in. But there's a lot of education as well as practical stuff that we do in the markets. So, you don't just learn about what we do in the markets, but you get to actually see it being used in real time. So it's kind of cool. So when I go into that program right here, E-mini think tank, there it is. We basically get together 3 days a week, and I got my monthly trade tracker. What we do is actually start off the class. Let me just kind of show you every session. Oops, wrong one. I'm going to go here and open. And I'll just show you a sample. Basically, I start off the class with some trade ideas. So for instance, some previous ones that we had were this, and I'm not afraid to show that we do take some losses. And let's see, silver, that was a winner. Didn't see what the targets were yet if we reached those, but actually we did. We reached both of the, target one, we got stopped out for target two, but I had a couple losers there. But we start off every class with these trade ideas, and then we look to see how they're going to play out and what we're looking at in the market. So it's kind of neat. As far as the results, actually, I have June's results right here. I can show you that because we just finished. Thursday was the last session for the E-mini think tank. And we finished off pretty well. We had 21 winning trades, only 12 losers. So I had a win rate of about 63%, which is not bad. It's not perfect, but the nice thing is the average loss was $560, while the average win was almost double. So, we don't have to win all the time to be successful. And there's still 6 pending trades out there, one that's still open. So, I was talking about that one trade I just saw in that trade sheet from the silver. So let me see. I forgot to see what the resolution of that was. Silver, up there it was. Yep, that's still open. That's the open trade. So like I said, we did hit target 1, so I got to update that, but we haven't hit target 2 yet, I think. But I track everything we do, and you can see there's a lot of trades that just don't play out because prices don't get there for whatever reason. We have rules that we follow, and part of that is understanding supply and demand. These are entries based on what I'm going to talk about today for supply and demand, and that's why I typically do so well when it comes to these strategies, because I follow those rules pretty religiously, if you will. And actually, I could show you for the E-mini think tank. If you're interested in joining us in the E-mini think tank, I can get you a link for that as well. But you can see so far for the year, we're doing pretty well. I mean, January killed it. February fell off a little bit. But, I don't know if we just didn't have as many trades, or no, they were smaller wins. That's why. Interesting enough, I actually on February had bigger losses than I did wins, but we had more wins. So do I send an alert when the trade enters? Not in the E-mini think tank program. I do that in my other programs. I just don't have enough time. There's so many. So what we can do though is you set up the alerts, obviously, on your own platforms. And if you have all the parameters, why you would enter, why you would exit, then you can set everything up ahead of time. And that's what most of the trades are designed to do. You take a look back at that trade idea, and you'll notice we have 60-minute trades, 15-minute, those are day trades. but we also have 4-hour trades. And those are ones that obviously are not going to hit right away. You can set up the trades and let them go. And it's all, again, based on supply and demand. So if I go out to my trade platform here, and for instance, well, here's that silver trade. You can see the reason why I entered. It's drawn out there on my screen as a supply zone. And I'm going to talk a little bit about why I find those zones and how I find those. I think that was the hourly chart, if I'm not mistaken. Yeah, it was for the entry. And first target was right here, which was another demand zone. Of course, we surpassed that. And actually, no, the first target was a little bit lower. We haven't reached it yet. So this one's still active. But anyway, you can see that, there's reasons why I enter where I do. And again, it comes down to supply and demand. So we'll talk a little bit more about this. Let me see here. Go into my links page. I think it might open on this one. But yeah, if you want alerts, I do that in some of the other programs, like the Wealth with Spreads. But for the E-mini think tank, that is, again, a mix of day trading and swing trading, where you can get the ideas ahead of time. But also the main thing is learning how to use what we talk about in the real market. So there's the link. If you're interested in the E-mini think tank, you can join there. The Wealth with Spreads is the program where I do send out alerts when the trades come into play. And that's doing pretty well as also. So let me copy that. And if you're interested in that program, that is there. So I gave you both the links for that. Anyway, let's go into our discussion for today. And basically, the way we got to look at supply and demand is first understanding how order flow works and the reason why, behind the supply and demand. Why is this actually something we want to follow? And it comes back, at least for me, my humble beginnings in the markets. I started off as a retail broker. Okay. And with being a retail broker, first of all, I hated it. It was just a sales job, and that's not really me. I'm not into that. I would show up, but literally, if you guys have seen the movie Boiler Room or Wolf of Wall Street, that's kind of what I did. We didn't have all the Quaaludes because it was in the 90s, not the 70s, but anyway, I was in California, Southern California, not Long Island either. But what happened was we were penny pushers. And I would get a yellow sheet of paper first thing in the morning with a stock and a story. And I was told to go sell it. And we had to make what they called smile and dial. We had to make 300 dials a day. Otherwise, we were in trouble for not doing our job. But we literally had to make 300 dials a day on the phone. It was crazy. So basically, I hated that. And I moved into back office operations. And in the back office operations, what I was doing there was handling order flow. So basically, a broker would talk to a customer and they would get an order to buy or sell. And then they'd turn that order over to me. And what I would do, actually before that, they would write it up on a piece of paper called a chit, as you see on my screen there. Sorry, I was kind of checking something here as I'm talking to you guys as well. But what would happen is they'd write the order down on the chit and they would give it to me. It was a blue chit for a buy order, pink chit for a sell order. And basically on the trading desk, I joke, I'd come into my office and there'd be a huge pile of chit on my desk every day, right? So what I would have to do is handle those orders and try to get them filled at the best possible price. Now, I would like to try to get a best possible price for the brokerage. Oh, you got an advertising letter from another company 2 years ago that had a picture of me and a paragraph? I wasn't even with them 2 years. Yeah, I wasn't with them anymore 2 years ago. That's funny. That old company. I left them a while ago, so they're still using my image. Weird. Anyway, continuing on, like I said, I was getting those orders filled and I would route those orders to what they call market makers, institutional traders. So I kind of saw this from my perspective. I also then left and I went to become a trader at a hedge fund. So I went from what they call the sell desk, a sell side there. I'm sorry, buy side. I was on the buy side there because I was dealing with customers, but I was handling the orders in the back office and trying to work with the market makers to get the orders filled at the best possible price, to then working with a hedge fund, doing millions of orders of trades, tons of trades, lots of size. And I was day trading as well as swing trading for the hedge fund, trying to make money for the fund. So I handle large order flow. That's the point. And what you got to understand when it comes to order flow, if you're at an exchange or even as an agency desk operator, you get all these orders, you'd stack them up. I worked, I got to get a royalty for using my picture for the ads. Unfortunately, I think I might have signed that away. I don't know. I got to check on my contracts from way back, but I think they're not supposed to use my image anymore. I mean, they shouldn't if I don't work there. It's kind of weird. Anyway, sorry, I digress. But what would happen is, operators on the floor or operators on the desk would stack orders up like this. The pink orders, as you saw, were the sell orders, and then the blue orders are the buy tickets, the buy chits. Now, just imagine if you wanted to buy right now this particular stock at $30, there aren't any orders there, right? You need a seller to be able to buy, or you need to buy. If you want to sell something, you need a buyer. You got to have somebody taking the contra on your trades at all times. And if you don't have somebody doing that, you just don't get filled. So what would happen is if somebody wanted to buy right now, hopefully it's not too noisy in the background, by the way, it's pouring here. We might get a little bit of thunder too. It'd be kind of fun. But anyway, if nobody wanted to sell to you and you wanted to buy at $30, we would just create an order there and lay it on the table until it gets filled. Now everything's done electronically, but you still see the same stuff, right? So for every trade that goes through, somebody has to be on the other side. And when you're trading with huge numbers, we're going to see what happens with that. It's not a big deal when it's 100 shares or even 10 shares or one share or one contract. But when you get into multiple lots or big sizes, that becomes a bigger issue. So, like I said, if you want to buy, maybe there's a lot of people wanting to buy. So if they're willing to buy right now, they don't care about the price, and they know there's a lot of sellers that are at $31, well, they'll raise their bids. That's what causes prices to go up. If buyers are aggressive, they're willing to take market price or whatever's available, they buy from the sell orders that are sitting there, and they'll take out those orders. Now, if anybody wants to buy, they're going to be stuck with the quandary is, do I sit tight at the price I want to buy and risk never getting filled, or do I suck it up and pay a higher price? If you pay a higher price, well, then you got to go to 32 at this point. Maybe they take out all the 32s. So there's a lot of buying pressure going on. It could keep going and going and going. But two things you got to realize about this order flow. Number one, let me go back to the beginning here. You can see the stack of orders gets bigger the higher you go. And that's common sense when you think about it, because people would love to sell at higher and higher prices. But what you don't see here is the amount of buyers, and the amount of buying pressure actually goes down because, as you get more and more higher in price, the buyers have either already bought at these lower prices, or they just don't want to buy at the high price. It's just too cost prohibitive. So at some point, as we keep going up and up and up, we're going to reach an area where there's just too much selling pressure and nobody willing to buy anymore. And that's an imbalance. That's what we're really looking for in the markets. If we can find that imbalance, if nobody wants to buy anymore, and there's a bunch of sellers there at $34, and they're seeing the market isn't going up anymore, they're going to start to get nervous because they saw people selling at 31, 32, 33, and now here I am at 34. I can't sell. Well, how do you sell something that nobody wants at that price? The easiest thing to do is lower your price, right? So that's what's going to happen. Somebody's going to start lowering the price and try to attract buyers, and they will keep lowering that price until they find the buyers. And that's what causes prices to change direction. So we can't see these orders, right? Most of you probably don't have access to this, probably never saw this in real life. But what we can see are charts. And by looking at charts, we actually can see where's the impossible. It's not always 100%. Okay, by the way, in technical analysis, everything always happens except for when it doesn't. Just so you know. Anyway, what happens here is, let's say we've got an area where there's a lot of buying pressure. Now, we don't know this at this time, but there could be a huge amount of buyers in this area. And if there are, and there's no sellers, that's an origin of imbalance, and prices will likely rise. And notice we did get some of those buy orders filled because there they were, the big stack. We got some of the buy orders filled as we moved up, even some of the sell orders as buyers were aggressive and pushed us up. But as I said, what will eventually happen is as we keep going up and up and up, we're going to lose the buying pressure because the buyers already bought at a lower price, or price gets to be too high and there's no reason for them to buy anymore. They're going to wait for prices to come back. So if we keep going and we reach that area, well, before we get there, we'll reach that area, prices will stop going up and might start to drop. Again, because somebody's going to drop their price to try to attract the buyers. Now, when I look at a pattern like this, and they are patterns, by the way, I equate it to an elephant walking in sand. It doesn't matter if the elephant tiptoes, they're going to leave an impression. They're going to leave footprints. So, the elephant wandering through the jungle, if you will, is going to leave footprints. And if we can see those footprints, we know we're following an elephant. And by the way, if you're trying to walk through a jungle on your own, it's probably going to be very slow. You're going to be hacking your way through with a machete, getting whipped by branches. It's not going to be very easy going. But if you walk down an elephant path, they're much larger than us. They're going to break the branches all the way there for us, probably leave a nice little trail on a path for us. And that's what we want to do in the markets. The elephants are the big institutions putting in huge orders, millions of shares, hundreds of contracts, all that kind of stuff. And if we can follow their path, you think about it, they're the ones who are making all the big money in the markets. And if we can follow what they are doing, we should be able to have very similar results. And as I showed you, the results that I've been getting are pretty good, right? I'm not going to say they're excellent. I think they're pretty decent. We have more wins and losses, and the wins are much larger than the losses. That's what we want to do. That's how you make money in the markets. Again, just kind of looking back, I only showed you, well, actually, I showed you 2 years. You can see 2022 for the E-mini think tank. Again, if I bring this a little bit bigger, so you can see it, win rate, my average rate was 71%. But the reason why I do so well for the average per month on the return is small losses, large wins. We follow the elephants. Go back to 2021. It's been pretty consistent for years. Small losses compared to the big wins and a bigger win percentage. I started this program, by the way, in 2020. And you can see, I think this year, we're pretty, I guess I'm right around 65% win rate, 71, 68, 72. So maybe 65, maybe 68% win rate overall. And again, keeping the losses small compared to the size of the winners. And we need to keep doing that, just following the elephants. That's all we're doing. So 2 things about this area right now that I note, and again, the pattern, following the elephants. That is an area where there must have been a lot of buyers and no sellers. And the reason why I know there's probably no sellers in this area is because we left the area very, very quickly to go up. It's a noise. Bear with me for a moment. Oh, sorry. Sorry about that. Anyway, so again, we have no sellers in this area, but lots of buyers. And the probability is going to be very high because when you're an institutional trader, you can't throw in all your orders all at once. Okay. If I go out, let me see. Oops, again, I got so many things open here. I got to close some stuff out. But if I were to go in, and let's say I want to go trade futures, it doesn't really matter what I want to trade, but let's say I want to trade the S&P 500. Just gonna let me see bigger. Do it like that. Oh, I'm not seeing the depth on this. I wanted to see the market depth. So let me see if I go over to charts, active trader. Is that the one? There we go. That's what I wanted to show you. Right here, if we wanted to buy right now, this is on the silver, right? So if I want to buy silver contracts right now, if I want to buy 50 contracts, I am not buying 50 contracts all at once. Look at that, 2, 6, 13, 13, 2, 3. There's not that many sellers there. That's the micro. But if I go, even if I go into the full-size contract, and I'm not sure if we're in the N contract or the U, let me check the volume. There we go. So if I want to buy 50 contracts, I can't even buy them from this level. I'm going to have to buy from multiple levels. And that's what happens when you're trying to buy large size. You have to go multiple levels to get it filled. Well, the problem is if you do that, you might scare the market, especially if there's not that many contracts being traded, or if we do shares, same thing. So what you have to do is what's called working the order. And with working the order, you buy small chunks at a time. Think about Warren Buffett. If Warren Buffett wants to buy something and the press gets wind of it, they print it up and everybody wants to buy that security all of a sudden. All right. And if everyone wants to buy that security, it's going to cause prices to rally really quick. And Warren's probably not going to be able to buy at a cheap price because he needs to buy so much. So instead, he's smart about it. First of all, he doesn't leak it out that he wants to buy right away. He buys small amounts in small chunks. And these are called iceberg orders. And it's something that happens quite often in the markets with these iceberg orders. You just kind of sneak your way in by buying in small pieces until you finally have everything you need. Well, what that does is it leaves behind orders. Institutions identify a range where they're willing to buy or a range where they're willing to sell. And what they do is they try to buy in a small amount. So they sneak under the radar, if you will. And they get to buy and they get to sell the small amount until they complete their full size. Now, it doesn't happen all at once. Sometimes prices move away because, again, there were no sellers here. Well, because of the patterns, we have a high probability. And a great question. Truman just said, how do you know there's a large imbalance in an area? How do you know if the zone will work? We don't. We know the probability is high that it will work because of what we see on the chart from happening in the past. So if I make an assumption, and that's all it is really, an educated guess, an assumption that this is an area where we had a lot of buyers and possibly an institutional buyer, but there were no sellers, what do you think is going to happen when you get there again? Why would anybody want to sell here when they could have sold at a higher price? They saw it go up. Would you want to sell at that low price in the future, knowing the last time it was here, it bounced? No. So unless something fundamentally changes in that security or in the markets, there's not going to be a lot of sellers when we go back to that area again. If there wasn't before, there's not likely to be again. And because we need a large size order to push the prices like that, there's likely to be an institution behind it. And because the institutions work the order, there's likely to be a lot of leftover orders. Again, they identify a range where they're willing to buy or sell. They buy or sell as much as they can, and they wait for prices to come back and they'll buy more. So prices rally, we can buy, and because we don't know for certain it's going to work, we put in a stop loss. Let's see the same thing on my charts. When I go back to, it was SIL, I believe, on this one. No, it's not showing on that, but let me show you another one. Here's micro. Ooh, that one broke after it hit my target. But you can see, if I remove some of this stuff, that was my trailing stop I was using. There we go. When I look to enter the trade, and this was on the hourly chart, so let me go down to that. Come on. You know when that happens. There we go. Anyway, when I'm looking to enter the position initially, I always identify entry, target, and stop. I removed my stop on this one because we moved away, but you'll always see a little red line typically above where I'm looking to enter. Actually, this might have been a smaller time frame. I'm not sure what time frame that was on, but there was a zone here hit. Let me check to see if it's on 15. Nope, must have been bigger. Anyway, you'll always see a stop there because I don't know the zone's going to work. And if it doesn't work, I want to get out. I get in with high probability, I get out if it doesn't work. Simple. So here's another one on feeder cattle that I'm waiting for it to come back. And you can see it doesn't look like it's coming back. So I'm going to obviously abandon the trade. And there may be another opportunity right here to enter. And again, I'll explain how I'm finding these in just a few. But that's all I'm doing is I'm looking for the origin of imbalance. Why do we shoot up from that area so quickly? Actually, that's not a good zone. And the reason why it's not a good zone is it was already a zone back here. Take a look. Once again, if I'm looking for my entry, there was an imbalance and a move to the upside. It wasn't the best looking zone, but we used up multiple times all the buy orders that were probably in that area. Okay. So that's all I'm doing is I'm looking for patterns. There's a high probability, but it's never certain. So that's why I was putting stops. So in this case, prices rally up. And the same thing, we hit an area of lots of selling pressure, but prices rally too much. There's no more buyers, so it comes down. And basically, if I know this was an area where we had lots of buying pressure and no sellers, it's likely to repeat that again in the future. So all I have to do is buy when prices come back, put my stop loss below, and there it goes. You know, we could do this on any chart, any time frame, any security. If I were to go to, let's say, the NASDAQ. So we'll go to the current NASDAQ. And I'll just go back in time. It doesn't really matter. Obviously, we know what's coming now, but if I were to go zoom in and go back randomly, got to make sure we have some good data here. Oh, here's a bit of an imbalance right here. Now, I am a little handicapped in just looking at zones right now because I'm also not looking at trend. Trend is a key point. We got to make sure we also identify the trend of the security, because what will happen is when we identify these zones, basically there's different kinds of zones. We have demand zones and we have supply zones. Actually, I should put the supply on top. So supply and demand zones, right? And to answer a question that came up earlier, yeah, I do use Thinkorswim for some of my order entry, but not always. I have some other programs I use as well. But with supply zones, we have an opportunity to either enter shorts or exit longs, right? And with demand zones, we can either enter longs or we could be exiting shorts. And what tells us how we're going to use that zone is the trend. So by just identifying zones, I don't know if this is an imbalance that's going to cause me to buy or if it's simply going to be an exit for a short. This one was actually here, but since we already saw the resolution, it went down from there. I didn't mark it, but there's a rally base drop right there. Okay. So as we come down to that buying area, let's see, there we are. Again, this was an area where there was a lot of buying pressure and probably no sellers. So we have a lot of momentum down right now. We may break through, but we should at least bounce a little bit here. And there it is, bouncing. Okay. Finally broke through because, as I said, the trend was nice and strong to the downside. As far as next zone, well, we have this origin of an imbalance. And again, moving forward, see if we come up to it yet. Nope. There we go. And you can see right there, it paused in that area, but we had enough momentum to break through. I do use the RSI as a momentum indicator. Again, we have to identify what the trends are doing, but in this case, we actually did react to that selling imbalance. Prices at least paused there. So we do get reactions. So basically, that's what I'm looking for, that order flow and where's there likely to be leftover buy orders and leftover sell orders. So again, when I go into, let's see here, trade ideas, showed you from a couple days ago. Let's see what else can I show. I'll go into, here we go, 615 trade ideas. Let's see how that worked out. If it did. Yeah. Just picking a random date. So anytime I'm looking at trade ideas, this is what I do. I identify, let's see, this one was canceled, again, due to trend. Okay. For instance, here, this was live cattle, LEQ 23. I was looking to do a short at that zone. Notice I identify my risk and I identify my potential profit before I get into the trade. Always got to do that before. So actually, I don't want to mess with this one. I'll bring it up here. LEQ 23. Happen to be on a 15-minute time frame. Oops, did that wrong. 15-minute, perfect. And let me clean this up. We were looking back on 15th of the month. Oops, I don't have enough data here. Is my RSI based on a 1 hour? It's based on the time frame that I'm trading on. So if it's, if I'm on a 15-minute chart, it's based on the 15. But to answer the question regarding trend, it's based on the higher time frame compared to where I'm trading. So again, there's a lot more to all this. I'm just going over some of the basics right this moment. But anyway, going back in time, let's see, where were we here? 12, 13, 14, 15. There's the 15th. So this was a short opportunity on live cattle. I was looking to sell short. Let me clean this up. There we go. I probably can pick it out right about here. I imagine, let me see. Oh, it was 172.20. It's actually this right here. I'm not mistaken. Yep. 172.20, 172.60. So again, on the trade idea, there it was. 172.20, 172.60 with a stop loss of identified $220 of risk at 172.75, and then I had my two targets. I do actually let my stop loss move. I have rules regarding that too. So yes, I do move my stop loss to lock in profits. I have rules for everything. Why would I cancel a trade? I have rules for that. Anyway, here's an entry. You can see we went up into the zone. Notice the origin of imbalance right there. This was nice. We actually broke down strong enough that we took out two prior lows. Okay. And why? Great question. Why did I pick that zone instead of the one above it? That's the one we get to first. And not only that, look at how we left that zone. Two large candles and then followed through a little bit, right? Here you just had one candle, pause, and then finally followed through. So obviously the one I'm going to get to first is going to be the one I'm going to watch. And sure enough, that one worked. I moved down. But that's what I'm going to do. I'm just going to look for the origins of imbalance. And as I mentioned, there's patterns behind this. So when it comes to patterns, what we're looking for is objective areas. Okay, we don't want subjective. We don't want to have a bias. We want to have objective areas, irregardless of the time frame that we're looking at. It doesn't matter if we're looking at a 5-minute time frame, 15 daily. It doesn't matter. It always works the same way. And that's what we need to look for, something that we can use everywhere at any time. And let me go ahead and clean up a few things I have here. Too many charts and stuff open. There we go. So the nice thing about charts is that they are fractal. Whatever works on a small time frame also work to a larger time frame. Okay. Absolutely. Great suggestion. Bonnie was just asking about doing a class in the E-mini think tank on how to revamp rules and build the rules, basically build a plan. So that's something I will do 100%. I'm the powers that be when it comes to the classes. So I'll write that down and create that. Okay. Now that's basically how I work. I figure out what students are struggling with or needing help with, and I work to create something that I can do to help them. So anyway, that's part of the E-mini think tank. That's what we do. As I said, you go into the E-mini think tank, by the way, where is it here? Members area, and you'll see there's class recordings from the live classes that we did, but more importantly, there's bonus videos of education. And you can see that I've done things on LA waves, seasonality, scalping trends, certain strategies I've created, how to exit properly, the order placement, basics, even how to find zones right there. Trading routine and finding zones. How do I do all that? So all that information is there for my students. And as I mentioned before, if you're interested in joining me in the E-mini think tank, by all means, I would love to have you there. There's a 2-week free trial, by the way. If you want to just kind of kick the tires, so to speak, if you join on the quarterly subscription, there's a 2-week free trial where we don't even charge your credit card. So you can try this all out for free. And there's no reason not to, right? And by the way, there's also documentation that goes with all that. So the rules that I have, Why would I cancel a trade? I think that's in there, right there. When trade ideas should be canceled, what would constitute a reason not to take a position? And, rating trades, figuring out what's a good opportunity, how to actually find the zones. What do I do before I trade? And rules. So lots of good stuff there available for my students. Anyway, we want to copy those institutional traders, as I said. So we got to find patterns that tell us when to buy and when to sell, where to buy and where to sell. So as I said before, it's not so easy to just find zones. You have to have the context of those zones. Is this an area where we should be buying, or is it an exit for a short instead? Depends on the trend. So we got to master not just finding the zones, but multiple time frame analysis. So that's what I love about this E-mini think tank program. As I said, I try to provide a lot of education. There's a lot of self-paced education that's here, where you can go in and watch the videos. There's tons of bonus videos, and also, like I said, documentation that supports it. If you ever have any questions, obviously we're in a session 3 days a week, 9 a.m. to 11 a.m., Monday, Wednesday, and Thursday, but you can also message me and ask questions. I get back as soon as I possibly can to people. So it's a pretty good interactive program, I like to think, if you're interested in trading futures. So, and even if you're not trading futures, there's also a lot of good basic information with that supply and demand that you can take to other assets as well. Anyway, we want to be consistent in our trading. So I put together a lot of rules, and it's a little more restrictive than what I have seen other people who use supply and demand. When it comes to supply and demand, it really does work well, as you saw with the win-loss ratios. So basically what it comes down to is we have two types of candles, and that's what I use, as you saw, candlestick charts. So we have what are called basing candles, and we have what are called leg candles. Now, this is not the same thing as the formation of a zone. In the zone, there are going to be 3 pieces to every zone, okay? And those pieces, I was looking at something there. Those 3 pieces to a zone, I might as well put it, actually, you know what? I'm going to go here. Nope, it was in the wrong spot. I'll go here. Close that out for now. And it's just easier for me to type on this one. This is TradingView. And the market's been rallying like I thought they would today. So again, when it comes to candles, we have 2 types. Okay, we have leg candles. And leg candles basically show price action. Price is actually moved in a particular direction. We also then have base candles. And base candles show indecision or a balance between buyers and sellers. Okay, that's what that shows. Balance between buyers and sellers. However, when it comes to a zone, they have 3 pieces, or 3 components. Actually, that's probably better. 1, you have the leg in. 2, you have the basing. And by the way, the basing can have leg or basing candles in it. Oops. And number 3, we have the leg out. And honestly, part of the leg out, we could subdivide that. We have the leg out candle and the follow through, which is after the leg out candle. So those are the 3 components of a zone. And we need to have all 3 pieces. If you're missing one, it's not a zone, period. It's really what it comes down to. And you can see I've marked off zones. This is what I put out on Twitter today. So if you want to see good examples of this on a regular basis on the S&P futures, you can follow me on Twitter, as I mentioned. At Trader B Dub. And be careful, there's a lot of people that try to copy and change my name a little bit, try to fake. And I've had some imposters, so be careful. It's Trader B Dub. No hyphens, no underlines, no nothing else. Just at Trader B Dub. Anyway, and like I said, you'll see examples of this over and over and over again. These were the demand zones I identified on the S&P futures today. And I also do stuff on other ones, other securities. So it's not just the S&P futures. So we have base and leg candles. What the heck is that? Well, base candles show no commitment to trend. They usually have sideways movement or lack of commitment, lack of momentum. While leg candles show that either the bulls or the bears were in charge and prices moved in a particular direction. That's it. A base candle is simply a candle that closes within the range of the previous candle. And the range of a previous candle is nothing more than the high and low of the previous candle. That's it. That's the range. So if you have a candle that currently closes within the range of the previous candle, which is the high and low, it's basing. It doesn't matter if you close at the high or at the low. It's like baseball. Tie goes to the runner, they get the base. So the wicks, by the way, they can stick out. That doesn't matter. Remember, the close of the candle is what we're counting. So if it's a green candle, it's the top of the body. If it's a red, it's the bottom of the body. So a basing candle looks like this. You simply closed inside the range of the previous candle. Another one here, notice we closed not in the body, but in the range, right? Wicks count, close inside the range, it's a basing candle. Even if you protrude above or below the legging candle, it's all about the close. Here you can see we closed inside a red candle with a green. Closed again, even though we stuck out below, we opened below, doesn't matter. It's all about the closing price. You get 4 prices on every candle: open, high, low, and close. And all we really care about is where did it close? Who won? Bulls or the bears? And in the case of a basing candle, nobody really won because we didn't exceed the prior range. We didn't get enough momentum to move outside of the prior range. Now, a leg candle is a bit different. And a leg candle is when you do close either above the prior candle's high or below the prior candle's low. Okay, the wicks, again, don't matter. It's where you close. Did you finish either bullish or bearish in that case? And that's it. So we're looking at candles here. Again, we opened inside the previous candle's range, closed below the low. That's legging out. It shows that the sellers were in charge. And not only did we go below the previous candle, but we actually were able to close there. The sellers won. You know, it doesn't matter if the wicks went above, as long as we close below in this case. Or in the case of a green candle, we close above the high of the previous candle. You could actually have a red candle close above the high of the previous candle too. You could have a gap. So anything, you know, like that could happen as well. So when I go out to a chart, and here I am on a chart, and we can, again, go back in time randomly and just play the game, leg or base. And the easiest way to do it is put in a line at the high or the low of the previous candle. Actually, let's do it this way. I'm going to remove that. I'm going to remove all my drawings and do this. Here's the range of the prior candle. Right there. Let me take the label off. Oops, where's it? Labels, no. That doesn't matter, I guess. No, I have to do it differently because I don't want those labels there so you can see the lines. Actually, I can do it this way. No, I can't. Oh, well, I was trying to make it easier. Let's try it again. Left. There we go. Now we can do it. So looking at the current green candle on the hard right edge, we can see we're closing above. That's a leg candle. We go to the next candle, and that is a base candle because there's the high and there's the low of just that green candle. That's closing inside. That's a base. Next candle is a leg. Actually, let me do it better. Do this. There we go. So we see the low of that candle, the high of that candle, and we close below, that's a leg. Next candle, well, I just move to the low and the high of the previous candle. There we go. As I zoom in, you can see that's a base. That's how easy it is between leg and base. Next candle, base. Next candle, leg. Right? That's all I'm doing is just looking to see where do we close compared to the previous candles high and low. Now, why do I need to know all that? Well, because when it goes back to, let's see, can I get those back? I go back far enough. I realized I had all that text on there that I was drawing. Go to the end. Did I lose it all? Nope, there it is. The reason why I knew it would go there if I got back far enough is that when it comes to a legging candle, we need to have a leg candle. Remember, the basing can have either a base or a leg candle, and the leg out candle must actually be a leg candle. Remember, I said there's a difference between basing and base candles, and there's a difference between legging candles or leg out and leg in. Okay, but typically a leg in or leg out has to be a leg candle. It's got to show imbalance. We're looking for the origins of imbalance to be able to trade, find the best opportunities where the leftover orders are from the institutions. So what it comes down to is there's really 4 patterns. And I kind of talked about the institutional order flow. Well, if we can find a pattern that shows us an imbalance and the evidence of an institutional order flow, there's a high probability, not 100%, but there's a high probability that when we come back to the origin of those zones, that there's going to be that leftover institutional order flow that gets the remainder of those orders filled. Okay, remember, I said they're trying to fill big amounts of trades and large shares. So they can't do it all at once. They'll start to fill some of the orders and fill the rest so when they get back. That's it. So here's one of the first zones that I look at. Is called a drop-based rally. And again, it's all rule-based. In order to find a drop-based rally, number one, you must have a leg in. In this case, it's a drop, so it's got to be a leg down, meaning the close of the legging candle has to be below the low of the preceding candle, period. Next, you'll notice I got this little shaded area in yellow. The high and low of the legging candle define my basing. Okay. Now, there will be zones that do not fit into this criteria. Okay. There will actually be zones that don't quite fit in this criteria, but this is a great place to start because the problem with a lot of traders is they have a lot of subjectivity when it comes to their trading. They don't know exactly where to get in or out. They kind of feel like this might work. It works if you follow the rules. You know, we want to find the highest probability turning points. This is where you do it. So again, it won't encompass all the turning zones. As you get more experience, especially in the E-mini think tank, you'll start to learn some of the other types of zones that'll work for us. But to start off with the basics, this really does work very well at finding a majority of the zones. So between the high and low of the legging candle, any candles that close in that range are part of the basing, period. That's it. The basing includes all the candles that happen to close within the high and low of the legging candle. Then we have a leg out, and that leg out has to do 2 things. You see number 3, the leg out candle has to close at first above the leg in candle because it can't be part of the basing. That wouldn't make sense. But it also has to be a leg candle, so it's got to close above the preceding candle. That is the important part right there because that's showing the origin of imbalance as we're leaving the zone. And if you don't have that imbalance, you don't have a zone, period. The next 2 candles that follow through should be making new highs. If they don't make new highs, it's not going to be good. You really want to see that imbalance continuing. There are going to be exceptions to this, and I do teach that in the E-mini think tank. So again, if you want all the rules and you want to get practice, you got to join me in the E-mini think tank. First, as I said, you get the videos where I go through this in a lot more detail, a lot slower. Plus, you got the documentation right there, leg-based zoning technique that walks you through step-by-step how to find these zones. Can the leg in be an engulfing candle as long as it closes below the preceding candle's low? Yeah, not the close, but the low, previous candle's low. Yes, it can be. You know, I had a really good zone. Let me see, where was it? On Bitcoin a while back. That was BTC, USD. Because I was in a group where I was talking about on the daily chart that we were in a downtrend. Now we're back in an uptrend, the long term, but let me clean this up actually. There's it. That was the weekly. That's what I was doing there. Anyway, on the daily, there was a downtrend going on for a little bit here. Weekly, we're in an uptrend. Now let's clean it up. This is what I was talking about right here. And I think it was, let me see where, oh, there it was. I don't know if you guys remember this, but that was the day that right here, they announced that, I can't remember which one it was. It's like Bitstamp or one of the big brokerages was going to get investigators shut down in the US, something like that. And then obviously it came right back up the day after. So people were saying, oh, this sell-off was a great opportunity to buy. Binance, that's what it was. Thank you, Bonnie. Binance. So they had the big announcement on Binance on that day. And everybody's saying, oh, this is a great opportunity to buy. And I was like, wait a minute, no, we're in a downtrend. You don't buy until you hit strong demand. And you see we weren't at the demand zone yet. Look, there's a basing and rally. Now, the strong demand zone really is down here. The one I just showed you is a drop-based rally. So let's follow the rules here, right? You've got the leg in, closing below the previous candle's low, basing. Look, if we look at the high and low, oh, that's not it. This is fun. Oh, where's my shape? Let's do it this way. Right here, there's the high and low of the leg in candle. You see, we got close inside, close outside. That's my leg out. So we have leg in. Actually, I can do it this way. Two candles close inside the range of the leg in. There's your close out. That's the leg out. And we had follow through. That was my demand zone that I was looking at, the big one. There was also, as you saw, the other one right above it, which I haven't talked about yet. That's the rally-based rally. And what happened? Binance news came out. We ended up going lower and bouncing off demand instead. Was that a better area to buy? Meanwhile, there were a bunch of people who were telling you to buy on this day. After prices were coming down on Binance, they were telling you to buy here. And I said, no, wait until it gets down to 25.50. Wouldn't that be a better area to buy rather than up here at 26,000? I mean, you're saving yourself quite a bit of money per coin. That's why we want, and it works on Bitcoin. It works on crypto just like it does on other securities. So anyway, that one I just showed you was this rally-based rally, where you have a close above the previous candle's high. Same thing though. The high and low of that leg in candle define the basing, because any candles that close inside, and they could be leg candles or they could be base candles, but anything that closes inside of that leg in is part of the basing. Then you have the leg out, which actually close above the high of the leg in and above of the basing candles, right? And there's other criteria too. And I usually basically use the low of the formation and the highest close, of the basing candles. So that's how I drew these Bitcoin levels here. You had the leg in right here. Notice that's a close. I'll just do this. My leg in is this. There's my close above the previous candle's high. These are the only two candles that close within the range of that candle. There's the high and low. There's my leg out. Didn't quite follow through as well as I'd like it to, but notice I drew bottom of the wick in the basing and the high of the closings, or the high of the body, it should say, not closings, but highest body. And that defined a really good buy opportunity for Bitcoin. Meanwhile, it's gone up $6,000 from my demand zone. Anyway, just saying, same thing here. Leg in, base, leg out, and follow through. we actually have another new demand zone right here. Rally. Let's see, actually, let's get this right. We have high and low right there. So that's my leg in, right? Closed above the previous candle's high, base, base, leg out. Great. So now I know my zone is that. We have the leg in candle, two candles that close inside the range of leg in, leg out, and follow through. So if prices fall back down, I'd look for a buy opportunity there. Why? Because that's where there's likely to be leftover institutional orders, just like they were back here from March. Perfect time to buy in June. Who knew? Well, anybody knows supply and demand knew. And the same thing happens with supply zones for targets or for shorting. You have a leg in candle, basing any candles that close within the range of the leg in candle, and then leg out has to close both below the leg in candle's range and the previous candle's range. That way you have that imbalance in the selling pressure. That's how you find the high probability opportunities. And then the last one is not that much different. Instead of a leg up, we have a leg down, basing, and then the leg out with follow through. That's it. Now, I know I went over that last part pretty quick. So again, if you're interested in learning more about all this, I've told you multiple times, I'll say it again, you can learn this in the E-mini think tank. So if you want to click on that link right there, E-mini think tank, if you're interested, as I said, you can get a 2-week free trial, and sure, probably can do this. Let me see, where is it here? Oh, I'm on the wrong page. Trying to find something for you. I guess I don't have it open anymore. Oh, there I do. I'll tell you what I can do as well, because normally when you click on that link, you're going to see something like this. Come on. Can't get this open. I'm going to give you guys a little special since you're here with me today. If you're interested in joining the E-mini think tank, as I said, it's 3 days a week. We do the live action simulated trading. You get a 2-week free trial with a quarterly subscription. If you click the link, normally you'll see it's $995 per quarter, $399 a month. So you can do the quarterly and get the 2-week free trial, or $399 to get the monthly subscription for this. And, I showed you the results. Didn't hide anything there. The results this last month for June, we did pretty well. Pretty good investment when you look at it. But I'll make it a little bit better. Since you're here, you can use a coupon called My Future or Futures when you're enrolling, and I'll take a little discount off that for you as well. Pretty good size discount, actually. So instead of the, it's $250 off, so we'll do $749 for the quarterly, or $349 if you decide you just want to do monthly and go month to month. And as I said before, you get the 2-week free trial if you do it for the quarterly subscription. Staggering results. Thank you. So yeah, if you're interested, as I said before, you can use the link I've been putting in the chat there. I'll do it again right there for you. And if you have any questions, by all means, let me know. You can get a hold of me. Oops, I hit the wrong button there. At, let me see, bring in the chat again. Support at wealthbuildershq.com. Or you can also obviously find me on Twitter. And if you got any questions, love to help you out. If you're one of my students already, then you can definitely get a hold of me pretty much through the class or through the messaging that we have on the, where is it here? Members area there. So I want to thank everybody for being here. I got to run, but hope to see you again in the future, especially in the E-mini think tank. And if you got any questions about any of the other programs I work with as well, you can, again, send an email to support@wealthbuildershq. And I'll talk to you again soon. Have a great holiday weekend if you're in the States. 4th of July coming up soon. So take care, everyone. Trade safe, trade well.